It's been a wild couple of weeks for the stock market. The S&P 500 has sunk to the lowest point since November 2024, the Nasdaq is now more than 10% off and it's officially in correction, even the Magnificent Seven that looked invincible in the past 2 years are falling. And the reason for this can be found in three things: the trade war of the Trump administration, the job reports of last Friday, and the Fed's decision to hold interest rates as long as they don't have greater clarity on Trump's policies. So today I want to talk to you about how these factors are impacting the stock market, what I believe is going to happen in the next months, and also want to give you 5 steps that you need to take to ensure that you're going to go through this crisis unarmed and richer than before. Now, the trade war has certainly been the heart of the market drop down, while investors waited how far President Donald Trump would be willing to negotiate on tariffs. Thursday last week, Trump said he would post tariffs on some Mexican goods, and the White House later said the delays also include goods from Canada. Still, last week concluded in negative. As I always said in my channel, and I hope viewers listened to me back then, when a correction will come, and it did come now, tech and growth would be the most impacted parts. So I hope you didn't go too heavy on tech and growth stocks in the past 12 months, like I suggested, and now you can instead start buying more growth little by little because the price is getting cheaper every week. But getting back now to the trade tariffs and what Trump said last week. President Trump signed an action on Thursday adjusting tariffs on Mexico and Canada. Goods that are compliant with the United States-Mexico-Canada agreement will not be tariffed for now. Those that are not compliant will face 25% tariffs. According to a post from CNBC's Megan Casella on X, a White House official said that roughly 50% of Mexican imports and 62% of Canadian imports are not compliant. Moving to the job reports, the last job report came out last week and it didn't meet expectations, fueling investors' panic and sell-off. The US economy added 151,000 jobs last month and the unemployment rate rose to 4.1%. But economists were actually expecting 160,000 jobs to be added in February and an unemployment rate held at 4%. So imagine a negative job report coming now that the Trump administration is slashing government jobs on a large scale with Elon Musk's DOGE, the Department of Government Efficiency, and it's going back and forth over its trade policies. So you can imagine that the combination of these factors, which might potentially even have a good impact in the long term, is indeed putting pressure on the economy and unsettling businesses and also private investors. On Thursday last week, data from Challenger, Gray and Christmas showed job cuts increased in February to 172,017, their higher monthly level since July 2020. This means a 245% increase in layoff announcements from January. In the report, they say that cuts from the government and Elon Musk's DOGE drove the increase in job eliminations, followed by retail and tech. When it comes to interest rates, Jeremy Powell made clear that the Fed is awaiting greater clarity on Trump's policies before making a next move on interest rates.
Looking ahead, the new administration is in the process of implementing significant policy changes. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
Powell said that changes in trade, immigration, fiscal policy, and regulations are creating uncertainty. Hence, a wait-and-see approach is the best way to go before any monetary policy adjustments. Considering that the Fed's next policy meeting is scheduled for March 18th or 19th, I don't expect rate cuts in this meeting. So now you have to imagine that investors already last year were expecting multiple rate reductions this year, and it was already priced in the stock markets. So obviously, not seeing these cuts at all in the first quarter of the year drives prices back down. And by the way, not to brag, but this was exactly what I said at the beginning of December last year in this video, where I explained that the market was overvalued also because it was pricing in the rate cuts of 2025, and if there were to be delays in the rate cuts, the price would have gone down, and that's exactly what happened. So if you don't want to miss these tips at the right moment, remember to subscribe to the channel. Anyway, for now we should expect the Fed to hold rates steady in the 4.25–4.5% range. And from what I understand from Powell's speech, any rate reduction in the future will depend on clear economic signals rather than market speculation. Now, all I've said so far doesn't really sound promising for the stock market. I know, but here's an important warning from me. Do you remember how in February 2020, when news of the COVID pandemic came out, the world was shocked? Everybody was terrified and thought it was the end of the global economy. So a lot of regular investors started selling stocks, and in a matter of weeks, the S&P 500 crashed by 30%. But then the world realized that for every new problem, there is always a new solution. So remote work came out to allow working during the pandemic, governments supported the economy, and the market shot back up just as fast as it went down. But what happened to all the people who sold on the way down? They lost a lot of money. So my message to you is, above all, if you're relatively new to investing, bad news and crises are always going to come at some point. And no matter how bad they look, people have a way of finding a way. Let me give you an example. Trump taxes imports from Canada. Short term, the economy struggles and the market goes down. Long term though, maybe American companies manage to increase the US production to respond to less imports or develop new technologies to fill the gap of missing resources from Canada. You don't know. So no matter how bad the news is, the tendency is always to find a solution and get better than before in the long term. And the worst thing you can do is listen too much to the news and panic when prices go down. Instead, you could watch my channel and I try as best as possible to inform on what's happening without creating panic. So, if you want to avoid panicking and selling during a crisis, ask yourself, what could be the reason for selling your stocks? And besides listening too much to the news, there is one important reason: being dependent on your portfolio. So here's the step number one that you should take to protect your money, and that is make your portfolio unnecessary. And you do this by having an emergency fund that covers at least 6 months worth of expenses. So if you spend, for example, $3,000 per month, you should have at least $18,000 in liquidity in a high-yield savings account. This has two advantages. First of all, in case you lose your job, you can survive 6 months without having to sell your stocks and ETFs, which gives you time to find a new one. And second, and this is what people never think about, is that having a safety cushion gives you the psychological comfort that you need to not panic when your portfolio goes down. Because if you are totally invested and you don't have enough cash at your disposal, you're going to panic every time the market swings because of bad news. And you don't want that. Alright, Rick, having cash at hand is a good thing to help us withstand market crashes. But it's not all. If I'm like 20 years old and I lose everything, I can still get back on my feet pretty easily and without problems. The same is not valid if I'm older though. Totally true. In fact, as a young investor, a market crash is actually an opportunity. You can buy stocks at a cheaper price, you can learn some useful lessons, and it's a quite valuable experience. But that's not always true if you're older. And this is why your portfolio can't be the same regardless of your age. When I receive comments and emails asking me for a suggestion for a perfect portfolio, I know that there is not a perfect portfolio for everybody. Instead, many personal factors influence what's right and wrong for you. And by the way, in order to help my subscribers with their personal financial situation, I'd like to start one-to-one consultations with my viewers. So if you're interested, you'll find a link with a huge discount in the description below. Anyways, there are two main ways to protect yourself while getting closer to retirement age, and they both involved having so-called bonds, which are low-risk investments that provide steady income. Usually, when you're in your 20s or your 30s, you don't need bonds. But starting at 40, 45 years old, you can start considering them. And above all, when you're 10 or 20 years from retirement, bonds become an important part of your portfolio. There is not a perfect way to calculate exactly how much of your portfolio should be made of bonds. But what I usually suggest is to have a percentage that is equal to your age minus 10. So if you're 65 years old, for example, you would have 65 minus 10, 55% in bonds. But I also suggest that you start with bonds at around 45, 50 years old, not before. One good way you can buy bonds is by buying an ETF called BND, the Vanguard Total Bond Market ETF, and rebalancing the percentage year after year according to your age. To help you with this, I created this file for you that is based on the 3-fund portfolio and that you can download for free from the link in the description below. The 3-fund portfolio is composed of an ETF for the US stock market, an ETF for the international stock market, and BND for the bond market. With this tool, you have a suggestion for the perfect allocation depending on your age. You can easily write your desired allocation, and depending on your current portfolio value, the tool tells you how much you need to sell or to buy in order to get to the exact percentages that you need. European alternatives are, for instance, the iShares USD Treasury Bond 0 to 1 year USD ITS ETF for US bonds, or the iShares Core Euro Corporate Bond USD ITS ETF for European bonds. The second way to have bonds in your portfolio is by using target date funds. The way they work is that they hold a mix of stocks and bonds that automatically changes over time as you age. The shift in the asset allocation over time is called glide path, and ensures that at every age, your portfolio automatically increases the percentage of bonds to become more stable the closer you get to retirement. Okay, the third step is different from the first two because the first two assume that markets will recover in the future. But I hear more and more international investors doubting the future of America, and even some American investors are now doubting that America will keep being the best performing market in the long-term future. My perspective is that the US still has a long way to go as the fastest growing economy, but I can't be blind to the fact that many Asian emerging markets have been creating solid foundations for a strong growth for the past 30-40 years, and countries like China and India in particular are actually posing a threat to the American dominance in the long-term future. Now, it's true that America has the highest entrepreneurial spirit among all countries, and even though the US has terrible social issues like the problem with health insurance access, criminality, and a high level of poverty, it still brings out every year the biggest companies that move the world economy. Still, if we compare the performance of the American and European stock market between 1973 and 2010, they were always running close. In the next 15 years instead, American tech companies and the technological advancement through AI have pushed the American stock market. But again, nobody can predict the future. That's why step number 3 to protect yourself for the future is global diversification. Knowing which country will perform better is impossible. But exactly for this reason, it's important to protect yourself and cover more bases to ensure that if a market like Asia or Europe starts performing better than the US, you keep getting the best returns you can and have the lowest volatility. There are many ways to diversify globally, but usually the simplest ways are the best. So if you are a US investor, my suggestion is VXUS, which gives you the best global diversification on developed and emerging markets, including small, mid, and large cap companies. If you invest from Europe, you have two options. Either you already have an S&P 500 ETF as a separate ETF to cover the US, and therefore you can buy EXUS for international coverage, the MSCI World ex-USA ETF from Xtracker. Or you can buy the Vanguard FTSE All World UCITS ETF that, with a 0.22% expense ratio and a fund size of over 17 billion euros in assets under management, gives you access to the whole world, including the US. Alright, moving to step number 4, we need to ask ourselves what kind of assets we're going to invest in. And just like a gambler that loses money in the casino and starts gambling more and more to gain back the lost money, sometimes when investors panic, they tend to invest in risky stuff because they hope to recoup the losses within a month. Don't do that. This is exactly the time to focus on high quality assets. That means investing in companies and ETFs with strong fundamentals. Here's what to look for. Number 1, diversification across strong sectors, not just like tech stocks or the latest fad. You want ETFs that include industries people will still need no matter what. Healthcare, consumer staples, utilities, and yes, even boring but reliable blue chip stocks. Number 2, solid historical performance. Past performance doesn't guarantee future results, but if an ETF has survived multiple crashes and still delivered over time, that's a good sign. And number 3, low fees or low expense ratio, because the last thing you need in a downturn is an ETF that quietly eats into your returns like a Netflix subscription you forgot to cancel. Instead of panic selling, stick to ETFs that hold high quality, profitable companies. They may take a hit in the short term, but in the long run, they tend to recover and thrive. Now, the last thing you absolutely need to do, and I know it's hard when the market goes down, but it's the best you can do, is avoiding the terrible mistake of stopping investments out of fear. Here's the thing. Market corrections are actually a huge opportunity if you keep investing regularly. So remember this word as a mantra. Dollar cost averaging, DCA. The simple, boring, but ridiculously effective strategy of investing at regular intervals no matter what the market is doing. When the market drops, your fixed investments buy more share. When the market recovers, these cheap shares increase in value. And most importantly, you avoid the stress of trying to time the market. Because, let's be honest, even the so-called experts get it wrong. So, beautiful people, I hope this video was useful. If it was, don't forget to subscribe to the channel and drop a beautiful like. And let me know in the comment section below what you think about what's happening to the market right now. I wish you a great day, everyone. And as always, I'll see you in the next video. Ciao.